Right, guys, just before the exam, I had a lot of questions and queries surrounding unrealized profits. So, manufacturing per se was not the problem, but this whole issue of what is the unrealized profit, what do we do with unrealized profits, what is the rationale behind unrealized profits, and then most importantly, how do we treat unrealized profit out of the accounting sense of the word? Now, unrealized profits, let's assume we have a manufacturing entity, and this entity is actually making furniture. And then once they've made the furniture, they sell that furniture to the general public. Now, what happened in the past was the following. Now, let's just ask ourselves for a moment, why do we get something like unrealized profits in a manufacturing environment? And then furthermore, what is the consequences of the decision to make use of unrealized profits? And then lastly, what is the accounting implications? Now, in our little example where we actually manufacture furniture, we have on this side the factory who's responsible for this manufacturing of the furniture. And on this side, we have the sales department who sells that furniture to the general public. Now, the people who gets rewarded for the sales that takes place and the profits that the entity make is the sales department. And then the factory guys said, yeah, but wait a minute. If it wasn't for us, there wouldn't have been any furniture for you guys to sell. And if it wasn't for us, the quality of that furniture could have been so poor that in any case you would have been able to sell any of those furniture to the general public. So therefore, if we don't make and produce a proper quality type of product, you wouldn't have made 1 single cent of profit by selling this furniture. Therefore, we want to be part of those guys who get recognition for the fact that if it wasn't for us, there wouldn't have been any profits for the entity as a whole. Now, that is the reason why unrealized profits or the policy of creating unrealized profits come into play. The entity goes and says, well, yes, we recognize that the factory has a very important input in making this furniture a successful product and helping the entity to make a profit by selling this product. So we will give them a part of the profit. All the profits won't be accumulated by the sales department on this side. They can get a portion of the profits in the factory as a result of the nice furniture that they produce. So that is the reason why there is such a thing as unrealized profits. Now, what is the consequences of such a decision? Now, the factory here is going to charge, once they're going to transfer the finished furniture that they've produced to the sales department, not only the cost of that furniture as part of the cost price of the goods to the sales department, but they're also going to add a certain profit to the actual cost of manufacturing of that furniture when they transfer this furniture to the sales department. But now, if that furniture is not being sold to the general public, so it's just standing on the floor, no profit actually has been made on any of these furniture items. So the consequences of the decision is if any of these items are still on hand at year end, the actual cost price of those items will not be reflected in the finished goods account, which is a sales department account, because in the finished goods account, this furniture will be recorded at the cost plus the profit element that was added by the factory when this furniture was transferred to the sales department. So the accounting implication is that I have to show furniture or finished goods furniture, which is part of my inventory figure, at cost or net realizable value. And the cost of that furniture is only equal to the actual manufacturing cost without the unrealized profit component. So for the statement of financial position purposes, I have to reduce my inventory figure at year end again to my actual cost price of the goods manufactured. A further accounting implication is that once I've sold these goods to the general public, now where does the sales activity takes place? In the sales department. And according to the sales department, the cost of these goods that they're going to sell is much higher than what the actual cost of manufacturing was. If the cost of sales is much higher, then it means that my profit is lower than what it should be, because the actual cost of these goods that I've sold was the actual manufacturing cost. So in my statement of profit or loss, my profit is also not correct for the goods that I've sold, because my cost of sales is also a too high a value, and I have to adjust that as well for the entity as a whole. So let's have a look what it looks like. Here we have our factory. What do we happen in our factory? Then we accumulate the actual cost of manufacturing this furniture. And that consists of my direct material that I've used in the production process. It consists of my direct labor cost, and it consists of all my overhead costs. And we know that these three are all being accumulated and transferred into my work in process account. So in my I work out my actual cost of goods completed in my work in process account, and that actual cost of my goods completed, that I will transfer to my sales department. So let's assume that that actual cost of the goods that I've completed equals 100. So that is the actual cost of my goods that I've manufactured. But now I don't transfer the goods at the actual cost to the sales department. No, I'm going to add a profit to that actual manufacturing cost. And let's assume that the factory adds another 20 Rand for every 100 Rand, so 20% to the actual cost in order to determine what is the cost of this furniture that they're going to transfer to the sales department. So to the sales department, they're going to see that the actual cost of this furniture transferred to them equals 120 Rand. Now you can see that this 120 includes the unrealized profit component of a 20. The sales department goes ahead and they're going to sell this furniture to the general public, and let's assume that they're going to sell that furniture at an amount of 200 Rand. According to the sales department, the profit that they've realized on the sales transaction is 80, 200 less 120. But if you look at the entity as a whole, what was the actual value of the profit that they've made? It was the 200 Rand, which equals the selling proceeds, less the actual cost of manufacturing, which is 100. So the actual profit that the entity has made on the sales of these furniture items is not 80, but it is 100. So if we're going to have a look at our income statement, we're going to have sales of 200 Rand, cost of sales, according to the sales department and by finished goods account, 120 Rand, which will then leave us at a provisional gross profit figure of 80. This figure we have to adjust with the unrealized profit, which was realized when this furniture was actually sold, i.e. the 20. So we're going to add the unrealized profit of a 20 because it's going to reduce our cost of sales to the actual 100 Rand, which you can see there. 120 less 20 gives us 100. 200 less 100 gives us 100. So the unrealized profit portion is going to be added to our provisional gross profit of 80 to get the entity's actual gross profit of 100. So if we look at the accounting implications per se, in our work in process account, we accumulate all our actual manufacturing costs, direct material, direct labor, and overhead costs. Then we're going to add the profit percentage to the actual manufacturing cost, and we're going to transfer the actual cost plus the profit to our finished goods. In our finished goods account, remember it's the inventory account, we will have opening inventory finished goods, as at the end of last year. We're going to add the cost of goods completed, which is going to credit our work in process account and debit our finished goods account. Then we have to add the profit, and here we're going to debit our finished goods account, and we're going to credit an account that we call unrealized profit P&L account. On the credit side of our finished goods account, we're going to record our cost of sales, and this obviously would be the cost of sales as per the sales department. And we will debit our cost of sales account, and then whatever is left, our balancing figure in our finished goods account will equal our closing inventory of finished goods. Right. It is clear then that our finished goods account includes unrealized profit. It's included in our opening inventory figure. It's there. We have added it to our cost of goods completed, and then in our closing cost of sales include that, and our closing inventory includes that as well. So in our statement of financial position, we want to show finished goods as part of our inventory figure, but we cannot add it at our finished goods closing balance. We have to take out the unrealized profit that's lying in that closing balance of our finished goods inventory account. And that closing balance is, if we take out the unrealized profit of that, that is our allowance for unrealized profit. And we will only show in our statement of financial position our finished goods at actual cost price, the actual price that it costed to manufacture those goods that are still on hand at year end. So therefore, we're going to need our allowance for unrealized profit account to take out credit side. On the different side, I want to reduce my value of closing inventory finished goods to the actual cost price. So the allowance for unrealized profit, always a credit balance. What is the impact on the income statement? We said that cost of sales recorded in our finished goods account is also at a blown up price. So that also includes unrealized profit. And there we've seen that in our first slide where we've added this unrealized profit, which was actually realized during the year, and we've adjusted our cost of sales with unrealized profit as well as our gross profit. So what do we actually want? We want the actual cost of goods sold, not the blown up price, the actual cost of goods sold. And for that, we're going to have our unrealized profit P&L account. So in that actual cost of goods sold, we are going to have our realized profit as well as our realized profit for the year. And that will come from our finished goods account as well as from our allowance for unrealized profit account. So let's have a look at our accounting entries then in closure. Part of inventory costs is our work in process account, and in our work in process account we are going to accumulate all our manufacturing costs. We're going to have a finished goods inventory account, which is obviously a statement of financial position account because that's an inventory figure. Then we said, well, that will have an opening balance, finished goods, but that opening balance will include unrealized profit. So the counter leg of that to take out the unrealized profit is our allowance for unrealized profit account, which is also obviously a statement of financial position account. So the opening balance would be the unrealized profit reflected in our opening balance finished goods. This would be a credit balance, that would be a debit balance. Right, so during the year we're going to accumulate all our manufacturing costs, all our actual costs, direct material, direct labor and overhead costs in our work in progress account. And then we're going to transfer the actual cost of goods completed. The uncompleted goods will stay behind in the work in process account as a closing balance. So the cost of goods completed is going to be transferred to the inventory account. So we're going to credit the work in process account and we're going to debit our finished goods account with the actual cost of the goods. Now remember, our finished goods is at a blown up price, so we have to add the unrealized profit. So we're going to debit finished goods with the unrealized profit applicable on the actual cost of manufacturing, and we're going to credit our unrealized profit P&L account with an unrealized profit based on the actual cost of goods completed during this period that we're working with. Good. Then we say, well, this opening balance, this finished goods that we had in the beginning of the year, we've sold that. So we've realized that profit. So therefore, that allowance for unrealized profit based on our opening balance finished goods is not applicable anymore because we've sold the goods. So we're going to get rid of this allowance for unrealized profit. It had a credit balance, so therefore to take it out, we're going to debit the allowance for unrealized profit, and we're going to credit the unrealized profit P&L account with an opening balance that was lying in the allowance account. Good. In our finished goods account, the cost of goods sold, now remember this is the cost of sales amount for the sales department, i.e. it will include the unrealized profit, is going to be credited against the finished goods account, and the debit will lie against our expense account, cost of sales. Now, that is what is going to stay behind. Then it's going to be the balancing figure of our finished goods account, and that would be our closing balance finished goods. Remember, now at this stage, there is no balance left in our allowance for unrealized profit account. So at year end, when we have the closing balance of our finished goods, we have to create an allowance for unrealized profit again to take care of the unrealized profit that's lying in the balance sheet account, in the inventory account of finished goods. So we're going to credit our allowance for unrealized profit with the unrealized profit lying in the closing balance of finished goods, and we're going to debit the unrealized profit P&L account. So the unrealized profit P&L account. So what is then going to stay behind in our allowance for unrealized profit account? Only the closing balance of the unrealized profit as it was lying or included in the closing balance of our finished goods account. If we go to unrealized profit P&L account, it's a P&L account, so it has to be closed off at year end against the income statement. And at what account are we going to, or against what account are we going to close it off? Against our cost of sales. Because listen, what do we have here? We have our unrealized profit of goods manufactured plus our unrealized profit in opening inventory less our unrealized profit in closing inventory. And what is that? Cost of sales. So whatever the balance is, we're going to transfer this balance. So we're going to debit the unrealized profit P&L account, and we're going to credit our cost of sales account with the amount of which is the balancing figure in the unrealized P&L account. Because we're going to credit our cost of sales account, that will reduce our cost of sales. Here we debited our cost of sales account, so it's going to reduce that cost of sales amount with the actual amount of unrealized profit which was realized, i.e. which has something to do with goods sold during the year. Opening inventory was sold, so that is lying in here. We have transferred finished goods to the sales department, that is lying here, but some of that goods are still on hand at year end, and we took it out of that amount that we've transferred initially on the goods that was completed for the year. I trust that you understand the purpose of our allowance for unrealized profit as well as the purpose for our unrealized P&L account. Another word for this account is a manufacturing profit account, guys. Unrealized profit P&L, another word for that is manufacturing profit P&L, or just manufacturing profit. And here clearly you can see it has an impact on my statement of profit or loss. What is going to remain behind in our manufacturing cost account, or work in process account? Only if there was incompleted goods at the end of the year, the value of that incompleted goods, that will remain behind in the work in process account. If there was no incompleted goods at the end of the year, the balance on our work in process account would have been 0.